What if the next recession isn't a prediction, but a bet? Because that's exactly what markets are doing right now. Recession odds for 2025 have just jumped to 67%, the highest on record.
And it didn't happen slowly.
It happened in a matter of days, after one announcement sent shockwaves through the global economy. Trump's new wave of tariffs. Chapter 1. The data point that shook Wall Street.
The data comes from Kalshi, a federally regulated prediction market.
It allows traders to bet on real-world economic outcomes. And those bets now reflect a dramatic shift. 67% chance of a U.S. recession hitting by 2025. Just a week ago,
it was under 45%.
That's a 22-point spike, faster than anything seen during COVID, the 2008 crash, or the 2011 debt ceiling crisis.
This is not business as usual.
Chapter 2. The Trump tariff shockwave.
The trigger.
A sweeping set of new tariffs announced by Donald Trump. 24% on Japanese and German car imports. 20% on consumer electronics from Southeast Asia. Steel and aluminum tariffs on Brazil, Korea, and India.
Total value impacted?
Over $1.5 trillion in trade. Markets immediately reacted. Dow Jones dropped 950 points in 48 hours. Asian markets entered correction territory. Treasury yields inverted again. And now the bet is clear. This isn't just a trade war. It's the start of a global contraction. Chapter 3. Why markets believe recession is coming.
There are 3 reasons markets are spiking the recession odds.
Number 1. Inflation pressure returns. Tariffs are essentially taxes on consumers. Price hikes across imported goods mean inflation could spike, forcing the Fed to stay tight when it wants to ease. 2. Supply chain disruptions. Global companies are scrambling to reroute logistics. Ports, factories, and contracts are being renegotiated in chaos, just like in 2018. 3. Global retaliation. Other countries, especially China and the EU, are preparing to hit back. That means fewer exports, lost jobs, and market volatility.
Add it all up,
stagflation risk is real. Chapter 4. Traders sound the alarm. Kobayashi letter, a leading macro analyst group, posted, "This is the fastest jump in recession probability we've ever tracked.
The market is pricing in pain."
On Wall Street, the language is changing. From soft landing to rate panic. From resilience to retreat. From wait and see to brace for impact. And all of this before the full effects of the tariffs even kick in. Chapter 5. The Fed's Nightmare Scenario. Federal Reserve Chair. Jerome Powell now faces the worst possible mix. High inflation, slowing growth, political pressure from Trump, a potential recession signal flashing red.
Normally, the Fed could cut rates.
But if tariffs raise prices, that becomes inflationary. So Powell is caught. Cut rates and risk inflation. Hold rates and risk recession. No move is safe, and the market knows it. Chapter 6. Corporate America on edge.
CEOs are already reacting.
Major U.S. retailers are warning of price hikes. Manufacturers are delaying investments. Supply chain contracts are being restructured. In the background,
layoffs quietly begin.
Hiring freezes expand.
Earnings revisions roll in.
Corporate America is preparing for impact. They see the recession signal, and they're moving early. Chapter 7. Political chaos adds to market fears. With Trump back in power, policy is becoming volatile by design. He doesn't just use tariffs as policy. He uses them as leverage, and the market hates uncertainty.
Now add political gridlock in Congress, rising geopolitical risk in the Middle East and Asia,
banking instability from commercial real estate defaults. And you get a market that's starting to lose its confidence in the system. Chapter 8. What the yield curve tells us. One of the most accurate predictors of recession, the yield curve inversion. Right now, the 10-year Treasury yield is lower than the 2-year. That's a classic sign investors are fleeing short-term risks. Historically, When the curve inverts, a recession follows within 12 to 18 months. That timing puts us squarely in 2025.
Exactly what the market is now betting on. Chapter 9. What does a 67% chance actually mean? This isn't a crystal ball.
But it's a signal of how hedged institutional players are becoming.
When recession odds are above 60%, it means
Fund managers are adjusting portfolios.
bond markets are pricing in rate cuts. Cash reserves are rising.
It's not panic yet, but it's a coordinated shift to defensive positions.
And those don't happen by accident.
Chapter 10. How this could unfold.
Here are 3 possible paths forward.
Scenario 1. Fed cuts rates early. If the Fed cuts aggressively in Q2, it might soothe markets, but inflation may rise again. Scenario 2. Trade war intensifies. If Trump adds more tariffs, especially on China, recession odds could spike to 80%. Scenario 3. Global coordination. Best case, world leaders negotiate a new trade deal. Unlikely, but possible. Whatever happens, the markets are not waiting. They're betting. And the bet is simple. Recession is coming. Maybe not tomorrow. Maybe not this quarter. But by 2025,
They're pricing it in.